countdown. All right, everybody, thank you for signing up. This webinar is going to specifically around using the MACD. Now, I know we discussed the MACD in the past. It's pretty much on every platform, so I'm not going to get into details. I'm just going to introduce the man, the myth, the legend, which is the one and only Dan O'Brien. So most of you guys that know Dan or have known him for a long time, or if you haven't and you're brand new to this webinar, Dan's been in the trading business over 25 years and has developed his own strategies, but has also used the MACD quite a bit and has taught thousands of people over the last couple of decades. So you guys are in good hands. Stick around till the end of the webinar. We're going to have a webinar special. The webinar code is going to be MACD22. So if you are a new person looking to get started with the Academy, something will apply to you. If you are a current student, we'll have something special for you as well. So stick around to the end. But without further ado, Dan O'Brien, take it away.
Thanks, Joe. Appreciate it. Well, as Joe said, we are going to talk about the MACD today, and there are many ways to trade. Too many to list, that's for sure. But they range from really extreme HFT, high-frequency trading, PhD level algorithms, to another extreme, which would really where anyone can find on their trading platform from coast to coast. It doesn't matter who you are, and they would be things like the MACD that we'll talk about today, the RSI, simple moving averages, and so many more. But today we're just going to discuss the MACD, and I'll go over 3 potential trade setups that will hopefully help all of you. So your takeaway is maybe a couple of good ideas, something that you can use going forward, and you know, that's why we're here. And so thanks for taking time out of your day. And actually, Joe, there's a few times where I'm actually going to stop and ask if anyone has a certain question. So wait until those times. So that's what we're going to talk about. And or just to be a little bit more clear with what Joe just said, there's no trading program to buy today. I'm not selling anything. There's the MACD and the other things that we're going to talk about, the channel, moving averages, etc., are on all of your trading platforms. I don't know of any that doesn't have them. So there's no indicators to buy. So we're just going to talk about a couple of trades. And again, hopefully these ideas help you going forward. But like Joe said, stick around until the end, and maybe you'll want to join us in our live trading group. That would be up to you. So what is the MACD? I'm pretty sure that everyone who's here, anyone who will be listening to this video going forward, will know what it is in general, but I'd be crazy not to at least try to address that. And it stands for the Moving Average Convergence Divergence Indicator, and it uses 2 exponential moving averages, and they can be set to whatever you like. And I'm going to tell you what's on the screen, so I'm not going to keep that from you either. All right. So the moving averages, they subtract one from the other, and they get the MACD line, which is the blue line that you see on the screen. And then the signal line is derived from whatever the last period that you use is derived from the MACD line. That's the red line. That's an important one. That's the signal line. And what I use, Joe, you might want to write this down. So the settings for my MACD are 18, 45, and 21. That's 18, 45, and 21. Thanks. So the 2 main parts that I use for the MACD, or that I would recommend to use, are the signal line, which again is that red line, and the histogram, which is the vertical bars that you see going up and down. So those 2 are the most important. So the farther apart the red and the blue lines are, means that histogram is going to be longer from low to high. That means they're diverging from one another, and then as they get closer, they're converging. So think about it as stronger versus weaker of whatever the most recent move was. So that's MACD, Moving Average Convergence Divergence, or stronger and weaker based on your settings. Before I move on with the MACD, though, and give you the trades the 3 trade ideas, I need to really briefly explain the other things that you see. And so you see a couple of moving averages here. Now, I could have taken these off the screen, maybe I should have, but there's something that we use all the time. And they are Hull, Hull, Hull moving averages, which again should be on every platform that anyone here is using. The faster one that goes from yellow to a light blue, and they change colors based on their slope, that's a 55 period Hull. And the slower one, which would be a longer term moving average, is 233. That is also a Hull moving average. The white channels that you see are called the Donchian channels, and they are 20 bars offset 2 to the right. And they really should be on just about any platform. There was one question that I got years ago, and it was from a trader that was using Thinkorswim. Some of you, I'm sure everyone here is familiar with that. And they have it on their system, but it's called price channels. So look at yours. If you don't have the exact name Donchian channel, whatever futures platform you use, see if they have price channels, and then you can always call the platform and ask if it's under yet a third name. So those are 20 bars offset 2 to the right. The reason why they're offset 2 to the right is so that we can see breakouts. Otherwise, that white dashed line would be constantly at the lowest low and the highest high of every bar. So you'd never actually see a real breakout. The green dashed line in the middle is called a reversion to the mean, or you can call it return to the middle. The middle of what? The middle of the white channels. All right. So that covers everything here. And then on the right, so trying to keep it simple, and then on the right, this is a bid-ask delta chart. It's based on the volume. And the 3 main futures trading platforms that I know of, I use Blue Water Trading Solutions. That's what you see on the screen. And then Sierra Charts and Ninja all have a version of this chart. That should probably cover everyone who's here today or watches this video in the future. So once again, even this chart is available to almost everybody on every platform, which is excellent. Okay, in that chart we could talk about that for hours, but just on a basic setup here, does anyone have a question before I move on? And I'm going to get going here any second. I don't want to bloviate and waste your time. It's important. So I'm going to get right into it. But if you got any questions on any of these settings before I move on, let me know. Okay, doesn't look like it. Good. That's great, because this is very simple setup. But before I do go on to these trades, I want you to remember 2 things. Very important. Any indicator, whether it's a MACD or something on the other extreme, they are just tools to use when you're trading. There's no magic in trading. There's no holy grail, and I'm not coming at you today saying this is the only way to do it. There's many ways to trade. It's just a couple of great, I think, really good ideas to help you with your trading, and you can move on from there, or maybe add it to what you're doing now. But they're tools, and you got to remember, like you can use a tool one way, like a hammer, the right way, or you got that same tool and you try and pound a nail in, a 16-penny nail with the claw side, it's not going to work so well. So you've got the tool, but you're using it wrong, and that ties in with the other thing I wanted to mention is context. So the context in general to me means, is the market moving quickly like it does most mornings, or is it dead? I call the sideways movements one of 2 things: a coffin of congestion or a rectangle of regret. You might say don't diddle in the middle, whatever the case may be, but those levels are, unless you get some true breakout, massive volume that you see on that volume delta chart on the right, chances are it's going to be a problem. But that's the context. And if you can use that tool, use the hammer the right way, then you're going to do fine. Whereas in trading, it's the same thing. We're using a tool. Today we're going to talk about the MACDs. You use it the right way in connection with context, you're going to be ahead of the game. All right, so let's go ahead and move on, and we'll get started with the first trade. And what I want to highlight here is we're going to keep an eye on the red line. So that's the signal line. And the signal line, is it below the zero level or above the zero level? So this is going to be more like a trending indicator based on the MACD with the data points that we gave to you, or the settings that we gave to you, 18, 45, and 21. So it's like a longer term trend. So if it's above zero, then it should be trending up, and if it's below zero, it should be trending lower, or more weakness, more strength. But the markets do turn, and that's going to be not correct. For example, the red line is above zero. It's falling, but it's above zero. And this is before the open. You can see this 4:30 in Eastern in the morning, and then we move on to 7:30. The overnight high was up here at 3,900 and a half. Basically makes a double top. There's nothing happening. And then as people come to their trading desks early in the morning, there's a little bit of weakness, and they decide to start taking it down. Well, you can see when the red line, the signal line, crossed below zero, this is when things really started to move out pretty well to the downside. So you can look at the signal line as when it's below zero, a short at the top of the channel, or when it's above zero, a long at the bottom of the channel. So I've highlighted these areas with gold ellipses. And what I mean here is, so the red line is below zero, and you're not going to do, based on this trade number one, you're not going to look for a breakout. You're not looking for reversion to the mean. This may be for some of you your only takeaway. So, the other two were kind of cool, but I really like this one. So you're looking for a very high level to get short when the red is below zero, which we have here, or a very low level when it's above zero, but that's defined by the Donchian channel. So that's how they intertwine. That's how we put these two together. Now there's some other color ellipses on here, folks. We're going to get to those in a minute, but you can see the top of the channel, and then it gets to the top of the channel and goes down, top of the channel again and goes down. The red line is still below zero. Once again, that doesn't go to the top of the channel, so there's no gold ellipses, but there's another one. And by the way, this is today, ladies and gentlemen. All of these examples, if they didn't work, if there were no good examples to show you on the day of the webinar, maybe what I'm sharing with you might be an issue, might be a problem. So this is the only day I was going to use. So this all happened today. All right, top of the channel twice here, and then I know when it starts to turn, there we go. So there's the big gold ellipse down there at the bottom. Here's one more at the top. You're talking 38.47 down to the bottom of the channel, 43 and a little further. So that's a 4.5, 5 point move. So then it crosses the zero bound. And if you're only going to use the signal line as I want to buy a very low price, you'd be looking only at the bottom of the channel. And of course, you're going to miss all this move. But eventually, it's going to come back to the bottom of the channel. All right, and there, I've got some explanations for these, and we'll get to those in a minute. But if you just put in, and it's going to tie in with the volume chart over here on the right, a way to avoid getting run over. But we can't mitigate all of those. Now I looked at those mainly in the morning here. I'm not going to scroll through the entire day. Once again, I know your time is valuable. You want to get through these three trades and you can move on. So again, the signal line is above zero, bottom of the channel, big bounce. Now it crosses the zero bound right here, top of the channel, down, top of the channel, down again. There's one more. On the downside, it crosses zero here, and look at that, all the way back down to the bottom of the channel. that might be the last one. If there's more, at least you know what they're all about. But I did make some notes here. I want to go back to look at, we're going to look at 1027 and 1031 in a little bit more detail. So here's 1027 and here's 1031 back to back. And 27. Okay. So the market is coming down. You have net sellers on the way down. And if you're going to wait for the market to drop down to a much lower point than where it was trading, you're going to have to expect there to be more sellers than buyers. Otherwise, you're not going to get that lower price. So although we have to expect it, if it's increasing dramatically from one bar to the next, that's also a signal, ooh, something isn't quite right here. We might want to step aside. Now that doesn't really happen, not in a dramatic way. Negative 128, negative 199, that's the net aggressive sellers over the aggressive buyers. And this negative 324 is happening after you would have already been in. So this may signal some people that, you know what, there's a lot of sellers here and it's actually increasing a little. I'm going to wait just one more bar, and then with this negative 324, which is this bar right here, you miss a trade and a loss. But if you got in because it wasn't dramatically increasing to the sell side, there's going to be losses, and that would be one of them. Here's 1028. It's still at the bottom of the channel. It starts to crawl back up into the channel, but why was that circled? 1028, because this is where the buyers came in. You see the stark difference between the two? Huge. And with that, sort of thing, that little bit of subtle difference can make the big difference between one trade and the other, even though technically they're both, based on the MACD that I'm sharing with you, they're both valid. Now this one here is also important. This one is an absolutely no way. And I even highlighted the net deltas on them. So we went from negative 145, almost doubled in bearishness, to negative 285. That should tell you something. If you're short, you're very happy. If you're looking for a lower long, you need to wait, because the sellers are increasing against the way that you want to trade. Probably doesn't make sense. Go bar to bar and just wait. And if you get this sort of trading action over here, then you can make the appropriate entry. It doesn't happen if you just use a limit order. You're going to get smoked on this one. So once again, this is a very important chart, so I brought it up in the beginning, and it's a way that you can differentiate, or just kind of go into the details. Do I really want this trade or not? Even though if you like the trade signal itself, you would be predetermined. So I'm looking for a buy, a couple of ticks in this range around the bottom of the channel. But how does the volume look? And does it look more like this? Or, oh my goodness, this looks terrible. So, okay, that I don't want to delve on that point too much, but that's pretty clear in my opinion. Now I've got a few more notes here I wanted to look at. 1103. And then 1134, again, not all of them. So here's 1103. Now, as I mentioned before, most of the time, if you're looking for a long, as the market goes down, you're going to see selling down into red, sellers coming down to your level. So in most cases, you're going to see buyers as it goes up to the top of the channel. But this is the reason why I wanted to talk about that. This doesn't happen all the time. And here it is at 1103, 1104, where it's the top of the channel. And as it's going higher, you have net sellers. Right, so there's a buyer for every seller, but we're talking about the aggressive trader, not the limit traders. I mean, again, I could talk about this chart for an hour or more, but that's not the purpose of today's webinar. I just wanted to point that out to you because this is where you'd be going, all right, looking for a short up here at the top of the channel because the signal line is below zero. Oh my gosh, there's net sellers all the way up to the top. Sold to you, buyer, and it'd be a nice trade. And then 1134, and I think this will be the last one, then we'll move on. Okay, so we got a couple of things going on here. So 1134, the market is coming down, and we should once again expect to see negative sellers, negative volume, I mean, so the aggressive sellers hitting the bid, taking the market down. And that's just what we see. That's fine, expect that. But we can also see it goes from negative 109 to negative 212 and negative 240. That's increasing to the downside. Maybe we might want to wait a bit. And that's the purpose of, or the point of these other ellipses here. Now, if you wait, the market price only got to the bottom of the channel. And that's where you're expecting it to bounce. And it does, as you can clearly see. But the good news is if you're waiting for buyers and you see, oh man, it just dropped all the way down there. The selling got aggressive and doubled to the sell side, but then it stopped like you shut off a light switch right where you would expect it to. Bounces a bit, negative 246 doesn't lead to new lows. And in fact, as it slowly goes down a bit, you've got the aggressive buyer coming in, trying to take it up, and eventually the sellers give up. And the market turns and goes the other way. So that's a couple of great examples of how you can read the tape and use the bid-ask volume chart that's available on all the major trading platforms, and how you can use the MACD with the Donchian channel. So that's trade number one, where you use the signal line and the extreme of the Donchian channel for an entry. So once again, if you got any questions, it's kind of a lot. I'll answer it now before I move on. If you want to let me keep going, that's fine as well. Fair enough. Moving on. Okay, the MACD trade number two here is a breakout trade. And this can really be used in two different ways. Number one, it could be a true breakout entry with the MACD bearish or bullish signal. That is to say, if the red line is above zero and there's a breakout, you can just go for it just immediately, and I'll explain that in a moment. Or you can use it as a setup for trade number three, which is the RTM. We'll get to that in a moment. But before I talk about the actual breakout trade, I've got to say that this can be a love it or hate it signal. And I believe that the reason is really going to depend on the context. Going back to two important things, the context and the fact that everything is just a tool that has to be used properly. For example, this morning, the market was moving very fast, so breakouts were quite good because it was moving like crazy. But when it slows down, breakouts are going to be dangerous, and that's the change in context. I know it's boring, it's not sexy, but guess what? If you're not paying attention to that context, you're going to have problems. All right, so what is the actual trade? And I'm going to go back, and these ellipses are the blue color. And there must be two consecutive closes above or below the Donchian channel, two consecutive closes, and one of those two must have a net delta of minus 200 for a short or plus 200 for a long in one of those two bars. Nothing before it, nothing after it, it doesn't matter because you're looking for a breakout at that exact moment. So let's go back to those blue colors. We got several going up, some coming down. Okay, so the red line is below zero. Should be more bearish than bias unless it's actually making a major turn. And so we've got two consecutive below the bottom of the channel. That's why we have to have the channels offset two to the right so that you actually see that breakout. And we have another one here. Let's take a look at the volume right quick. 931 and 934. Here's 931. One of the two must be negative 200 or worse for a short. It was negative 341. You're entering on the second close because they both have to close. And then the stop would be a 2-bar stop. So it would be a tick or two, whatever you want to use, if you're short above the highest of the 2 bars, and if you're long, the lowest of the 2 bars. So that stop was never even close. The market broke out. Now what's the context? Context is early, and the S&P tends to move quite a bit, and the NASDAQ, of course, when it's early. Here's the next 2-bar breakout, 934. There we go, negative 266. That's the first bar. Here's the second bar. Here's the close. The entry is 60.75. The stop is up above 64. Straight down. Here's another one. This one I think was more like negative 600. This is an order book sweep. Another discussion that could go on for quite a long time, but look at that. Whew. They are just running over the limit buyers. Sweeping that order book. Negative, it's even worse than I thought. Negative 855, negative 454. Balances a little bit, goes lower. All right. If you trust me, I can just move on, but I can show you all of these. Here's two where the net sellers were again over lower than negative 200, but I highlighted this one because it came real close to where your stop would be. It didn't get there. It's got to be a tick or two above it. So it just barely got there and then came down. Then you've got another 2-bar breakout below the bottom of the channel with the volume, and it drops. Now remember, the context is going to change, and it went from bearish to bullish. Now you've got a breakout long. Let's take a look at the buys. 1014 plus 380. And then 1018. Whoops, I passed it up. Sorry. 259, 243. You guys see a pattern here? And now you've got way up here at 1021. And this is, after this, I don't even know if this is kind of stretching it, but it's there, 373, 2 consecutive closes, and it goes up even higher. Okay, so those are your breakouts. All right. And there may be some more later in the day, but I concentrated on those early because, again, the first 90 minutes generally tends to be the most volatile in the equities. Doesn't mean there can't be volatility sometimes all day. Last Thursday, it was very volatile on the way down. One-time framing from market profile, it reached a very low level and went straight up all day. So it can happen all day, but for the most part, on your average trading day, it's mainly in the first 90 minutes. Okay, so that is it. Now the third thing is the reversion to the mean. Now, as the market does slow, as the context changes, you can use a potential breakout if you see 2 consecutive bars close below the channel, but you say, wow, you know what? It's not as fast as it was. So I'm going to look at that as, there could be a change in direction. I'm not going to use that breakout, but I think I'm going to go for a return to the middle, reversion to the mean, and I used most of my examples here later in the day, so let me get to them. Here we go. All right, now for this particular trade signal, the histogram, the vertical bars down here, must be greater than 0 for a possible RTM long, or greater than or less than 0, like they are here, for a possible reversion to the mean short. And so we have the histogram below 0 goes to the middle, and the trailing stop. Oh, I failed to mention this earlier. My apologies. This is a true range trailing stop, which can be a potential change of direction as well. And it's set to 3. Its period is 20 with 3 ATRs. All right. So here's one, reversion to the middle. Here's two, to the mean, the middle, and once again right to the middle, and the market is going down. Now, we had changed directions, and there was a potential breakout down here, but at this point, is it really trending lower? No, it wasn't. It was still trending up. The Donchian channels, as you can see, the highs were getting higher and the lows were getting higher until about here, when the high of the channel was going lower and the low of the channel was also going lower. Ding, 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 there's another tip. And then, with the signal line being below zero, which is not exactly necessary on this one, but if you want to put it all together, you can do that, and you've got 3 consecutive RTMs for a nice move down. Now, I put a few ellipses here because, as I just mentioned, the histogram has to be above zero for a long, and you had a nice long here, a nice move off the lows. Strong buying, I already know that, I've already checked. It pulls back to the middle of the channel. The trailing stop is below, but the signal line is below zero. Again, that's not a deal killer for this trade because the trades, the market will eventually turn before that signal line goes above zero. It just will. Markets turn very quickly. So it's a potential trade. And in this case, it only moved up 1, 2, 3 bars, and it immediately comes down and trades up again. Now you're below the center line, and if you didn't take 1 or 2 off already, start to look to get out at break even the best you can. Okay. This one is not a short because the histogram is above zero. All right, and so on. So Al asks, what is RTM? It just means reversion to the mean. The mean of what? The mean of the white channel. Or you can call it return to the middle if that's easier. It's basically the same thing. Now, this one is completely legit. So we have the, well, so was the last one, but there was you might want to get out of this one a little bit faster than normal. So the histogram is well above zero, pulls back to the middle. The stop is under the middle, which is great. It's what you want. And in this case, the signal line is even above zero. So that's a reversion to the mean or return to the middle, and a time where you might say that was a huge move. You got a breakout up here, but because it's still bearish at this exact moment in time, I'm going to wait to see if there's an RTM, maybe even a bottom of the channel. Okay, it's coming down to the middle, and the stop is still underneath. I'm not going to wait for it to get to the bottom of the channel, you might say to yourself, and then of course even read the tape. That's 1455. And almost there. Oh, here we go, 1455. So in this case, that's a lot of selling, and these sellers got absorbed like the Thanksgiving turkey and the Christmas turkey everyone just had recently. So stuffed. They got stuffed like the Thanksgiving and Christmas turkey, meaning that they were selling it hard into a support level, and they got completely absorbed, stuffed by the limit buyers. Then they get upset. Oh my gosh, it's not going any lower, and they got to get out of their trades. So it goes from negative 331 to plus 189, and then as it comes back down, big sellers again, totally absorbed, and then massive 456, another order book sweep right there to the upside. Okay. So I think that's everything on my list. I know that we just had a question there. Al, I hope that was good enough for you. If there's any other questions. Okay, Mike. So he's talking about 2 bars in a row, so that would be the breakout trade. So if it's highly active and it's early, it would be the close of that second bar. And the reason why, let me scroll back to the beginning where we had several of those breakouts. there could, so you want two of them to close above it, 1 2 1 2, and that's where the volume was. The reason being is that you can have let's say that this was the first bar and then you're looking for the second one. It could just turn right around and go right back down into the channel. And yes, that's a good point, Kathy. It's a 610 tick chart. So this is a chart based on order flow, not based on time. And every platform should be able to change from a tick chart or a constant volume chart or time, of course, 1 minute, 5 minutes, 3 minutes. So it's more of an order flow, certainly not a time chart. So we want to see more bars be printed as the activity increases. So we don't care that it's 1 minute. There could be 1 minute of, say, a 20-point rip, just as an example. 20 points straight up, some news comes out. And it's 1 bar straight up. Whereas an order flow chart like this might have 20 bars inside of that 1 minute and give you all kinds of opportunities for whatever trading pattern or program that you're using. Yes, Ken, the whole thing was recorded. All right, so 3 trading ideas using everything we talked about that you should be able to put on all of your trading platforms this evening or tomorrow morning, whatever you like. As we promised, 3 trading ideas, nothing to sell as far as a program goes or anything. But if you would like to learn more about what we do on a day-to-day on a live basis and maybe some other more advanced techniques, well, then you can talk to Joe. Joe, are you there? And if you have a question, I'll type in the answer if Joe is talking. You're welcome, Dave. You're welcome, Mike. Okay, we got a couple of questions here. Al says, where do we place the stops for the 3 trade types? Well, the one, Al, I told you about was if you're going to use the actual breakout, that is below the lowest of the 2 bars. At least one. I would say use 2 ticks underneath it. If you want to use 1, that's fine, because it still has to go through that low. The idea is that there's so much buying in these 2 bars that it shouldn't be going below you. If the context is right, remember, you want to trade when there's high context, high volatility, and when it slows, and 99% of the time it will slow, then the only way you'd look at a breakout is if it's going to set up a lower trade, if you even look at them at all. Now the other ones, the reversion to the mean, you're going to use this trailing stop, the blue line, when it's going up, and red when it's going down. So once again, that is the true range, and the setting is 20, like 20 bars with 3 ATRs, 3 average true ranges. And then for the top of the channel and the bottom of the channel, that would just be whatever you're comfortable with. I don't think it needs to be more than 2. It doesn't really need to be more than 3 points, let's put it that way, because the volatility will ebb and flow. If it's really slow, you probably get away with 2 points. If the volatility is higher, 3, no more than that. Okay, and then Al, then you can trail it as you wish. As it gets through, if you get out in pieces, like 1/3, 1/3, 1/3, then when it gets to your second target, you better have that stop at break even, and you are welcome. Raul, how do you offset the channel by, again, 2, no more than that, and no less? Then that's just going to be in your settings, whatever trading platform you use. It should be just, looking at settings and just, making the effort to change it. You are welcome. So is these things, 3 trading ideas, something everyone here thinks you can use? Give it a shot. As usual, we always tell people if any sort of trading you're going to do, make sure that you start it. If you're learning something new, you got to learn on the simulator in trading. Don't trade with live money until you got it down pat. It looks like we might have another question or two being typed. You're welcome, Dean. You know, the going back to the basics, like the basics of how to hold a golf club. If you're holding it wrong, I'm a golfer, it's not going to work out well. So the basics, going over the basics of trading, like the MACD, is always a good refresher. And again, for some people, they just might say, "Hey, this is exactly what I needed." It could be a great addition to what they're doing now, or trade it on its own. That's correct, Alan. Another tool we can use to help us make a decision. You got it. But I think that's going to do it for me, folks. And Joe's going to talk to you a little bit.
Thank you, Dan. We appreciate everybody being a part of this webinar. So, as I mentioned at the beginning, I just posted our phone number. It's 888-203-3731. For somebody who's brand new, interested in joining the Academy, we do have a current webinar promo. You got to use the promo code MACD22. That's MACD22. Give us a call. Let us know you were a part of the promo. We're doing a 3-month special for only $1,500. For those of you that are current members of the Academy, Dan is doing a webinar, or I'm sorry, a mentorship starting January 5th on reading the tape. So, and how it all ties together with this trading method. If you are interested in that, the first 5, and those of you who have been here know the value behind this, it's only $2,500 for that mentorship. But it's only limited to the first 5. So give us a call, 888-203-3731. One of us will answer. We don't use an answering service. It is all 100% Target Trading Academy personnel. So again, thank you so much for the webinar. Dan, thank you. If you have any questions, I'm going to post my email in the comments, so feel free to copy it and take down the number, and I look forward to speaking to you guys. Thank you, Dan.